Well, I suppose I have two approaches. One, I like to sort of punt a bit, but that's only with a very little bit of my money. And then the rest of it, I like to have a very sort of stable approach. Because having spent so long saving my money, I don't really want to throw it away.
Well, the key thing for me is I'm doing it for the long term. I'm not trying to see a return in a few months or anything. I'm doing it for my kids, for retirement and for the future. So that governs my approach, really.
I have to take account of my age these days, that I can't necessarily fool around with money, so I tend to take a more conservative approach, buy things which don't necessarily give high return but will give a nice consistent return and of course look after the capital.
Hello and welcome to Stocktalk, Selftrade's regular programme discussing investments, markets and financial planning. This edition gets back to basics with a look at the stock market itself and approaches to investing. We'll be examining how the stock market works, what to look out for when selecting shares, and asking what are the benefits of building balanced portfolios. Over a century or more, stocks and shares have outperformed pretty much every other asset class, including bonds, gold, and even property. And it may be the place professionals go to invest, but the stock market has never been more accessible for the private investor. Price, performance information combined with modern dealing platforms make investment decisions as well informed as ever. But investment choices still require some thought and judgment. The stock market works like any other competitive market, matching buyers and sellers and pricing the companies listed. As a shareholder, you are part owner of that company and can profit in two ways. Firstly, as the valuation or market capitalization of your stock increases, then so too will your holding be worth more. Bear in mind though that values can also fall. Secondly, you're entitled to a share in the profits, and these are distributed by way of a dividend. Some of the most profitable long-term portfolios are built upon reinvesting these dividends. How you approach investing in the stock market will depend on the type of investor you are, and this programme is designed to help you decide just that. Over the next few minutes, we'll be talking to Mark Glowrey of Investors Intelligence and giving you our stock market insight. But first, here's our quick introduction to investing in shares. Shares in public limited companies, PLCs, are quoted on the stock market, and this means almost anyone can invest in them. Shareholders can be individuals like you or me, or is often the case, especially with bigger companies, institutional holders such as pensions or collective funds. So how should investors go about selecting stocks, and what are the risks? So are shares risky? Well, shares should be considered a higher risk instrument, certainly more so than cash, bonds or other collectives. And some shares are riskier than others. For instance, very small companies can be less stable than the so-called blue chip, bigger companies. But quoted shares are limited liability, meaning that the risk of being a shareholder is limited to your investment outlay. You can only lose what you've invested. The way that investment works is that the higher the risk, the higher the potential returns. So shares are riskier than cash, but that risk is compensated for by superior long-term returns. You need to have a good idea of your tolerance to risk before you begin to invest. Don't invest in shares that keep you awake at night, and mitigate against the risk by diversifying and using collectives such as investment trusts or unit trusts. If you put all of your money into the shares of just one company, you expose yourself to the risk of that company falling from favour. By investing in two companies, the stock-specific risk is halved. With 4 companies, it is a quarter of what it was. Building a diversified portfolio of shares, markets and sectors help to reduce the risk of investing. As the world gets smaller, the share or equity markets available to private investors is getting bigger. And the choice available to investors means not only geographic indices, but also market sectors such as telecoms, oil, pharmaceuticals and energy. A portfolio might include shares from the UK, so the FTSE 100, 250, All Share and AIM. It might include international shares such as the Dow Jones and Nasdaq in the US, or the German DAX or the French CAC 40 in Europe. So, what sort of investor are you? Here are 3 distinct types that might help you decide. Value investors seek out the hidden value that they think the market has missed. They look for undervalued stocks and wait for other investors to reach the same conclusion. Value investing is only really possible in inefficient markets. Where a market is efficient, where there is near perfect information, stock will not be undervalued but will trade at levels that the market considers to be fair value. In the larger blue chip markets like the FTSE 100, many investors, analysts and researchers operate, making the market largely efficient. although the market is always affected by fashions and fads, so ignored sectors and stocks may still offer value. Value is more often found amongst the smaller companies because poor liquidity makes it difficult for institutional investors to buy, and so there will be no need for analysts to track these companies. Smaller companies are generally the preserve of the private investor, but they represent higher risk. Growth investors select quality stocks that they believe will achieve superior returns over the longer term. A growth investor is therefore content to buy stock towards the top of its range. The risks involved in growth investing are lower than that of value investing, but the potential may be less spectacular. Contrarian investors are a breed apart and count amongst their ranks some of the greatest investors of all time. Contrarians analyse stocks and companies forming a view of their potential irrespective of what the rest of the market is doing. It does not always mean doing the opposite of what the market does. After all, sometimes the market is right. So, the benefits of investing in shares are their long-term growth potential, ability to achieve diversification, and ease of buying and selling. For a first-hand perspective on share trading, we spoke to Mark Glowrey of Investors Intelligence. I started by asking him what sort of investor he was.
I have several pools of investment, some of which are for the longer term, some of which are for the shorter term. I have a SIP, which is the aim of which is to provide for my pension, and that is very much aimed for the long term. I have some ISAs,